I've got a great guest. I've spent some time with him, leading up to this event. We've had some really healthy conversations, and we're really about changing the way people are thinking about the approach to creating wealth and value for investors in multifamily. So I have in the studio with me, I have Samson Jagoras. He's in the studio to talk about a new way to achieve a multifamily investor target returns. I think that's what we're all after, right? And he has a unique background and a set of skills that makes him uniquely qualified to discuss the world of real estate and technology and how they're colliding. We talked about this collision that's happening, right? After 9 years of scaling a marketing technology company, he's scaled it to over 100 million in revenue. It's pretty significant growth, and he's launched Vue Properties, a technology-enabled, mind you, technology-enabled commercial real estate acquisition and asset management company. What they're doing is they're working with private and institutional capital, family offices, individuals, public entities, and private corporations to diversify, source, acquire, manage, and develop commercial real estate. So excited to introduce Samson right here in the studio.
Patrick, man, thanks for having me.
Awesome to be here, man. I know you and I could talk for hours, and we did leading up to this event, but what I'd like to talk about really is just where are we right now in the state of how you see deals and conversations around getting to these target returns.
It's interesting. I got my start trading highly leveraged futures and commodities in the middle of 2008. So I lived through the housing crash. I watched investors get crushed. I've watched the market come full circle to where it is today. And this cheap money environment that we're in has created some pretty interesting dynamics in the world of real estate, mainly where it's all about investor returns. Mm-hmm. And there's not enough emphasis being placed on the user experience, or in this case, the resident, which is an interesting conundrum. Could you imagine if Steve Jobs was like, you know what? We're going to do this thing because look at the IRR. It's going to be great. And look at the cash on cash return. That's not how technology companies think about things. They think about what's going to create a better user experience because of what they believe, right? And in this case, I think that where the market's going in order to create value beyond just the typical renovation plan, it's going to require us to think a little bit different in how we're actually approaching the user experience, or in this case, the resident experience. And tech enablement is a big part of that.
Yeah, it's interesting. You mentioned something there. I think it's fascinating. I mean, just imagine, the young innovator having this brilliant technology idea, walking in trying to get funding with that approach, right? Not understanding who's going to buy the product, how will they use it, right? All of that stuff. And then that mindset, because technology and innovators, you scaled that company to $100 million. You understand that technology. I brought you in here because I feel like this is the future real estate executive that thinks in this term. Like I have a community here. I'm designing this community I get the revenue from rent,
yep,
and other things. But when I fully understand that customer of the future, then I'm going to be competitively positioned to really deliver and avoid risk, but also deliver best returns. But it's fascinating when you said that, because I think about that collision of this technology that's focused on creating a great, seamless, frictionless customer experience, and then you get to the operator and you're trying to get that product introduced, and it's like, well, what's the RR? It's different languages being spoken there.
It's competing goals, right? But it's like if you were going to buy a company and again, or a stock, and Steve Jobs got up on there and talked about how great the cash flow was going to be. It's not inspiring. That's not why people buy Apple, right? It's not why people invested in Amazon. They were thinking about how to create a better user experience, and so tech-enabled communities, I think, is going to be a big driver of what the value-add strategy is going forward. Anybody can manipulate the business plan or the financial model to accommodate a better IRR or look sexier from a cash flow standpoint. But when and if when the market corrects, it's going to be a determination of people get pickier about where they're spending their money and how they're spending those dollars. Mm-hmm. there's like three major buckets, right? You got your, increase your net operating income, reduce your operating expense, and enhance the rentability of your property. And I think that's the one that gets overlooked the most. But if you improve the rentability, you reduce your operating expense because you have less turnover, higher quality tenants who are happier, who will stay longer, who will spend more money, who will take the rent increases, right? I think the national average for turnover is like 50% on average of apartment complex units turnover every single year. So how do you reduce that? And technology is deflationary in that sense, that it just creates a better user experience.
Tell me about that, deflationary. I mean, is this just the computing power of everything getting, I look at this camera and I'm like, wow, the new version is 10 times better.
Yep.
But also, I remember the days when, you were paying minutes to use the phone, right? Like,
you didn't want to get hit with roaming, right?
Yeah, you're like, I'm not going to make that call right now because I only have 400 minutes left or whatever, right? So that's not even an issue anymore.
Yeah, I think a lot of the technology-enabled stuff was really reserved for A-class developers bringing new product to market, mainly because they were the ones that could afford it. Moore's Law says that technology advances 2x every 2 years, and as it advances, then it becomes more affordable. And as a value-add strategy, retrofitting these properties with technology is just becoming more and more attainable and more affordable than it has ever been. There's great companies out there that are bringing that product to the market. There's Latch, there's Smart Rents, there's Brevo, there's PayRange, there's Fourth ID, all companies who are creating this, let's call it ecosystem, of a singular platform and application that allows you better access to the platform, laundry, vending, payment processing. I think operators need to be thinking about how they're going to be accepting currency in the future. The last guest was just on here talking about blockchain technology and tokenization. Cryptocurrencies are here to stay. So, what payment processors are you actually utilizing? Are you going to be able to process rents in Ethereum and Bitcoin and whatever cryptocurrency, evolves coming in the future? So all that matters, and the technology that you decide to retrofit your property with will make a huge difference. Yeah,
and talk to me a little bit about what you're doing at Growth Vue. Tell me how your business is structured, how you're creating value. Obviously, in the opening, I talked about who you're serving and helping, but...
Yeah, I think right now, money, there's just a plethora of it. And so we set out a long time ago to be really dang good at sourcing opportunities for capital to be placed. And last year we sourced and screened somewhere around 1,100 multifamily opportunities, about $18, $19 billion in multifamily. There's irrational exuberance about the market continuing to keep up the way that it has. So we're cautiously optimistic as we move into multifamily and always looking for, good deals where we can really add value, where we get cash flow day one, because who knows what the market's going to do.
What are you looking for? I know you're looking for the cash flow, but when you're looking at these deals, what are you looking first? Market?
Yeah, we're being opportunistic right now. We generally like the Midwest and the Southeast for obvious reasons. I think affordability is going to be a big driver of housing and net migration patterns over the next 10 years. And that's, people from California are moving to Colorado, where I'm at. People from Colorado are moving to Kansas, right? And people from, Kansas are moving even further to the Midwest.
Right.
And people from the Northeast are moving down to the South. And so, people are looking for a better quality of life. And like I told you this week, right? Me and my family are out here this week.
Yeah.
And we're a bit of a rolling stone, right? We don't have to be kind of pinned down to one location. So we're going to choose, quality of life and making sure our dollar goes a little bit further. And I think multifamily operators need to think about the same thing. And so that's what we're looking at. When we're looking at these properties, it's like, where can we actually add value? A lot of these deals go full cycle, 2 or 3 times in the last 10 years. And so you're getting a deal where there's hardly any meat on the bone, and your value add strategy is to take over, do the same thing you've done for the last 10 years, and then push the rents on the tenant.
Right.
I don't think that's going to, long term, that's not very sustainable.
Yeah, and that's why you're leaning into the prop tech.
Yep, exactly.
What are you seeing in trends there? You mentioned some like laundry and...
Yeah, just, remote access control. I think COVID it took, 100 years for the Industrial Revolution to change our lives, 25 years for the internet, like 10 years for the smartphone, and 2 years, 1 year for COVID to completely change it. Used to go into places and not really see touchless access or touchless payment. That's everywhere now. So that's kind of becoming the gold standard. And then, smart technology, God bless the technologists. They're creating solutions, but they're not really thinking about integration because they don't understand the whole picture of how the tenant or resident experience exists. So you get these properties that have...
How do you bring those two together?
You got to integrate.
Well, number one, you start with being one, right?
Yeah, you got to be one. You got to integrate them into a singular application. You got to, work with companies on their open APIs in order to just create a better end user experience. I mean, when we were creating marketing technology in my previous life, we went down the long, hard road of trying to develop everything ourselves. And that's really challenging because you're running a skeleton crew to try to develop technology. And the reality of it is there's lots of great companies who do one thing really, really well. Like they do websites really well, or they do SEO really well.
Right.
So working with those companies that do access really well, or do property management really well, or do payment processing really well to integrate into a single solution is kind of the key. And there's great companies.
Think about it, a lot of it's built on iOS anyway, or Android. I mean,
Right.
ultimately it's all on, it has to work on that ecosystem.
Yeah, 100%. Yeah, it does.
I mean, so what do you think about, we've had this conversation about this collision between technology innovation and sort of the real estate executive of the future or investor of the future. What I hope to get out of this for others is maybe somebody that's listening has the capital, they're placing it, they're choosing sponsors, they're evaluating, okay, I put it here, I put it there, this strategic operator does this one is good at this, but now there's this understanding of these are the customers of the future, this is how people expect to consume and live, and the world of work is changing, all this stuff. But also, when you're choosing these sponsors, let's say, why is it so important that these value, and we used to say value add is just like granite, new cabinets, paint, all the
hardwood floors,
the basics. But what you're talking about is a whole nother level of value add. Why is that so important for investors to know how to identify those groups?
A couple reasons. I mean, number one, in a cheap money environment, it pretty much drives the business plan, which is, 5 to 7 year hold. We're going to turn the property and sell it to the next guy. I think we're going to start to see a shift to longer term holds. We're going to see a shift to longer term business plans that prioritize cash flow because the interest rates are going to go up and cap rates will follow, but they're going to take a little bit of time to come off of that. And so, your long-term retention of your tenants is going to be most crucial. And so just anybody can manipulate the financial model to showcase a better IRR. And if you're chasing internal rate of return, you run the risk of, either the sponsor or yourself getting excited about return rate without really understanding how we're going to actually get there. I opened the segment talking about that, right? Of like, look at how great the internal rate of return is, look how great the cash flow is. If that's how you're making decisions, it's backwards because you're not serving the customer first, right? So understanding beyond the business plan of, hey, we're going to go in and we're going to increase the rents by doing renovations on the property. How are you creating community? Are they installing, 5G Wi-Fi throughout the entire community? Are they doing remote access locks? Are they automating laundry? Are they including automated vending? Are they thinking about other ways to collect payments and processing payments and collecting rents and different, currency? I think that's going to be vital and something that investors should be paying close attention to, and don't get caught up in the hype of what somebody's track record is. I mean, there's a changing of the guard right now, about every 80 to 100 years, one generation exits the market and the next one comes. Baby boomers were the number one investors in real estate for the last, 70 years. And in the next 10 years, 100% of them will be over 65, right? So they're divesting their portfolio, and the market is changing, and new investors like me who come in with different backgrounds are thinking much, much differently about how to play the game.
Right.
And that's what every great innovator does in every single market cycle.
Yeah. What are you paying attention to outside of all of this? I mean, you mentioned reading a book about, was it deflationary technology being deflationary asset?
Yep.
Where are you getting your? I mean, you grew up in software and technology already, so you have an inside look at how those two different programs work, and you look at like even agile development, right? Like just the idea of making something better, but getting that feedback loop. You know,
Yep.
like we have a very slow feedback loop in real estate. You know, even the lease terms are a long, feedback loop. And with Airbnb stuff, it's daily. You know, or
Yeah.
Uber, it's every finished ride.
Everything's slow in real estate.
Yeah.
We just put 70 units under contract this morning, and it took 3 weeks to just get through the PSA. It's just like,
Right.
I spend a lot of time just thinking about the macro and just looking how the outside world is influencing our everyday life. Forget real estate. I mean, that's a fundamental human need that's not going anywhere, but it's going to be greatly impacted with net migration patterns, work patterns, family patterns. For the last 50 years, people have been moving into city centers. I think 2021, 2020, I can't remember which one, we had more people move in a single year than any time ever on record. So I would say that law of diffusion of innovation says that those are the early adopters. So migration patterns are changing, live-work experiences are changing. And so I just spend a lot of time not living in the world of real estate and thinking about what's happening in cryptocurrency and technology to better understand what's happening in my own industry.
Mm-hmm. So take us through, you mentioned these transactions, a lot of them that you're evaluating over a course of a year. Take us through just one of these, how's a deal get done for you in your mind? I mean, those investors that are, I don't want to say that they're new to the program, but we want to get between them and their money is usually an influence. Either it's attorney, CFOs, sponsors, all of these things. Let's take us through some transparency. What we should be looking at to get this deal done. And I know it's a loaded question.
It's a broad question, but process and systems, right? So I got started trading in 2008. And the first time you ever watch somebody take their account from 25,000 to $1 million and back down to 25,000, you start to learn real quick about risk management. Mm-hmm. And I had a mentor who said, in futures trading specifically, you're going to lose a lot more than you win in this game. Mm-hmm. Law of probability says it's all about managing your downside because your winners are going to be 10x your losers. So whatever you do before you get into the trade, just make sure you know what your exit plan is going to be. Mm-hmm. I think there's at least right now from what I've seen, and I would say I'm relatively newer on the block, there is irrational exuberance that the next 10 years are going to be as good as the last 10 years. And that I can keep doing the same thing and expect the same result. I can keep driving rents 3, 4, 5, 6%, just because that's how we've always done things. I don't know if that's going to be the case on a go-forward basis. So we're extremely conservative in all our underwriting. In fact, even on this most recent deal, when the lenders pro forma and the property managers pro forma come back more aggressively than yours, you're actually underwriting the deal appropriately. Mm-hmm. So we're not banking on rent growth being as good as it has been. We don't like to bet on the come, meaning we're not coming in and paying for other people's work that they haven't done. We want cash flow day one, and we want to be able to manage through any kind of unforeseen stuff, right? And there's a lot of people that got sideways in 2020 because they got into the deal expecting to be able to just come in and execute the business plan, which was to just drive the rents up, and they weren't prepared for any kind of economic downturn. So, some sort of black swan event is what we're always prepared for, and can we actually manage through it? A good recession or depression is going to last, 18 to 24 months. And so, what type of debt are we taking on? How are we positioning our exit cap rates? Are we cash flowing day one? Are we able to improve rents on a natural rent growth plan, right? Not something crazy like 7 or 8%, but something more like 3 or 4%. And if all those things line up and the deal makes sense and we're buying it at market cap rate or even a little bit better, then we know it's a good deal. Mm-hmm. But if I come in and I manipulate the numbers overly aggressively, then it can, shift my internal rate of returns, make it look super sexy, and I can convince myself of a lot of things, right? Confirmation bias kicks in, and you start looking at the deal thing, and then this is great, So you got to have other outside metrics that help you really control whether or not you should be investing in the deal or not. And oftentimes the best deal is the one that you didn't win, the one you lost on.
Yeah, and I imagine that's a lot. That's been a lot.
It's like 100 to 1.
Yeah.
Yeah.
And how do you? So, what we talked about even yesterday is getting the emotion out of the decision, and really getting to the data. And you did a great job explaining some of those. I love what you said there. Because that's a hard thing to do, because you see other deals happen and it's passing you by. How do you stay centered on those values to, I know it's an investment objective criteria and a discipline, but it's also, there's people that made those safe decisions, and everybody's doing good right now.
Yeah, I could have went like this in the last 10 years and bought something there
right.
and done well.
So how do you settle with that, knowing
well, because
you don't want to chase a market either, right?
Yeah, I was blessed with 2008, right? So I got baptized in the deep end of the pool, and I watched a lot of people get just bled, honestly, because they weren't prepared to handle it. I slept for 2 years with a laptop next to my bed to watch markets like the coffee market open during some of the most volatile times ever. So I have the fortunate wisdom and experience, have been through that, to know that this isn't, there's game theory, right? There's two types of games. There's finite games and there's infinite games, right? So finite game says that if you get a deal done and I don't, well, you're winning and I'm losing. But an infinite game says the only point of the game is to keep the game going. There's no winners, there's no losers. And just when the rules of the game, they think that they're figured out, the rules will change, right? And just because somebody's winning right now or ahead of you doesn't necessarily mean that they will long term. So my focus is on 20 or 30 years from now, right? We're building a legacy platform, and you don't build a legacy platform in 5 years. You don't build a legacy platform in 10 years. You build a legacy platform over 30 years, which means you have great investors who you're taking care of. You have great residents and customers, tenants, users who you care about, who you're creating a better user experience, and you're focused on that for the long term. So for all those young bucks that are out there getting at it, it's okay to be aggressive, but don't confuse motion and progress, right? You might win in the short term, but you're going to get blasted long term. And when you do, then I'll just come buy your deal from you.
Right. Rescue it. What are you excited about right now?
I'm actually excited about interest rates potentially going back up and tempering the market. I'm excited about, changing innovation and technology, cryptocurrencies coming into the market. And, I wouldn't consider myself to be right or left. I would consider myself to be laissez-faire, power to the people. So I'm interested to see how cryptocurrency and technology changes the way that our economy operates. More decentralized finance coming into the space. So I'm excited about that. And I just love chasing deals and putting deals together and building awesome teams. And it was a hard-fought 2021 for us.
Yeah.
And so, we're catching a lot of momentum in the first quarter right now. So I'm really pumped about that, and just thankful for all the people that I have on the team who've made that happen, because I surely couldn't do it by myself.
Yeah. You went through the early stages. You mentioned jumping right in the deep end. What's different about what you experienced then versus what we just went through with the pandemic and moving through all those unique challenges that really nobody had a prepared plan for?
Yeah. What's different is it didn't correct like it should have. We just threw a Band-Aid on a gaping wound. 2008, we got a little bit better correction. I think that there's some unique circumstances now where the next correction isn't really going to be a real estate type correction. It's probably going to be something else outside of that. If I had to guess at it, I'd say something along the lines of corporate debt. Cheap money causes people to do a lot of things that they shouldn't probably be doing, and so we'll see how that plays out over the next 5-10 years. I think that we have a big shortage of inventory on housing. We have a big shortage of supply, so that's not going anywhere.
Right.
The cheap money has made it so unattainable for people that it doesn't matter how cheap it is, that they still can't buy it. So I think that we'll see that kind of come back down to a more normal level. I mean, 69% of the U.S. population has less than $1,000 in their account. So I don't care if rates are at 3% or 2%. They still can't afford the down payment, let alone the mortgage.
Right.
When, like in my area, something's $500,000. So the demand for multifamily is going to continue to be there, which just like it was in 2008.
Right.
Yeah, I don't. That's as far as I can see into the future.
Yeah, and it's an unknown, but it's interesting of the lessons learned from going through that and how it strengthens and gives confidence to decisions that you make. As when things come at you.
You can't really. You can only
different.
Plan for it, right? Prepare for the worst, hope for the best. Nobody saw 2020 coming, but you definitely could have been prepared for it, right?
Yeah.
If you had a good break-even occupancy, you could withstand a 20% vacancy, whether physical or economic, in your apartment complex and been just fine, right? So who knows?
Yeah. Are you doing anything differently with reserves? I know there's sponsor reserves and then you have the lender stuff, but anything different on the conservative side there? Or?
I mean, we've been chasing a lot more attainable stuff, affordable, whatnot. So, you're taking down bridge debt to do that. So the lenders really want to make sure that the debt service coverage ratio is there when you exit in 2 or 3 years. So they really force that upon you. But we're looking at, longer term financing like HUD. I can get a 30-year fully amortized loan at 2.75%. So I do think that, if I'm thinking about value creation beyond just raising rents, having an assumable long-term fully amortized loan at 2.75% in 10 years is probably an asset.
Yeah. That's interesting. So tell us, we're going to wrap here in just a minute, but I'd like to learn a little bit about the victors you're trying to create, who you're trying to support. Is it on the technology side, the real estate side? You got a couple things going on.
Yeah, so primarily, Vue Properties. We're a commercial real estate acquisition and asset management company, and we work with public and private entities to acquire, underwrite, manage real estate. There's a lot of cash out there that needs a place to go. So we're really good at finding and sourcing opportunities, but we're also working with, larger corporations who need anonymity in markets. They need people to go in and be owner's representation for them to take things through acquisition, entitlement, maybe even development. So we're doing some of that as well. I'm also doing quite a bit of consulting. Been sitting on a strategic advisor role for a company called Fourth ID, where we're working specifically on creating more tech-enabled, multifamily community experiences that transcend access communication and mobile payments, and just kind of bringing those worlds together to make sure that we continue to be tech-forward, tech-enabled type of asset managers to make sure that we're just providing the best user experience for our residents, which is ultimately going to be the game long-term, especially if we're talking about longer-term debt and longer-term financing.
Right.
You tend to care about that a little bit more when you're not just going to sell the deal in 3 years.
Right. Quick question here. The DSCR, the debt service coverage ratio requirements on bridge debt, any
Yeah, it's just
requirements on that?
Is it somebody coming from the crowd?
Yeah.
Yeah, it's just they're trying to make sure that when they go to exit out of the deal, based off the projected rent growth and what the refinance term might be, like let's just say we want to get a 75% loan to value to some longer term debt, that we can meet that number so that the bridge lender can get out of the deal. So they're really more concerned about how the next lender is going to view the debt service cover ratio, not necessarily theirs.
Okay, interesting.
That makes sense.
Yeah, that's great. Before we wrap, anything I should be asking that I'm not asking?
No, I don't have braces. These are all natural.
Yeah, you mentioned Fourth ID. I'm curious there. What's the advisory role look like? Just helping them guide.
Yeah, it's there's a big disconnect. There's about $32.9 billion invested into prop tech last year, but there's a big disconnect between technologists and real estate guys. Again, which is kind of my unique background, as I've sat on both sides of this table. The tech guys don't know how to speak the real estate language. The real estate guys don't know how to speak the tech language.
Right.
You know, we talk about, in real estate, we talk about net operating income and OpEx and CapEx, and they're like, what's that, right? So helping them understand how to take their messaging to market as technology first type people and what a real estate person is thinking about is kind of where I fit in, right? So a lot of messaging, a lot of introductions and creating collateral and having those conversations to figure out if we can sell into some of these larger accounts effectively. But it's rolled out on several thousand units now and doing very, very well. And so, excited to see what the next steps are for that.
Yeah, that's awesome. I have some ideas around some of the conversations we're having on our Innovation Council. I'm sure we could pull you in for some
I'd love to
conversations.
I'd love to.
But listen, this has been awesome. I appreciate you coming down. Hopefully the family can enjoy a little bit more great weather.
Yeah.
And we'll be tracking what you're doing, and hopefully we'll have you back.
Yeah, I'd love
kind
to.
of all the different podcasts and different things that we're doing. But this has been an important conversation. Hopefully we can give some people some perspective on how to think differently about how they get to the returns.
Yeah, and if people want to just connect, LinkedIn's a great way to do that. LinkedIn. You can also check out our website, thegrowthvue.com.
Awesome.
I'm sure you guys put those in the notes.
Yeah, we will. Thanks for coming in.
You bet. Thanks.